The U.S. debt ceiling is the legal limit on the total amount of money the federal government can borrow to meet its financial obligations. As of August 2025, if the U.S. reaches this limit without congressional approval to raise it, the government could face serious economic and financial consequences. The debt ceiling affects everything from government funding to global financial markets, and failing to address it in time could lead to severe disruptions. Here are the top 10 implications of the U.S. hitting its debt ceiling and the potential consequences for the economy, businesses, and everyday citizens. 1. Government shutdowns and delayed payments. If the U.S. reaches its debt ceiling, the government may be forced to shut down non-essential operations due to a lack of funding. This means federal agencies, public services, and government employees could face delayed or suspended paychecks. Social Security, Medicare, military salaries, and other critical benefits could also be impacted, causing financial strain for millions of Americans who rely on government assistance. 2. U.S. credit rating downgrade. Credit rating agencies like Moody's, Fitch, and S&P Global closely monitor the U.S. debt situation. If the debt ceiling is not raised in time, these agencies could downgrade the U.S. credit rating, making borrowing more expensive for the government. A downgrade could lead to higher interest rates on U.S. Treasury bonds, which would increase the cost of repaying national debt and put further strain on the economy. 3. Rising interest rates on loans and mortgages. A debt ceiling crisis could cause interest rates to spike, affecting everyone who borrows money. Consumers and businesses could see higher mortgage rates, credit card interest rates, and personal loan costs. This would make buying homes, financing businesses, and taking out loans much more expensive, slowing down economic growth and consumer spending. 4. Stock market volatility and investor panic. Uncertainty surrounding the debt ceiling often leads to major swings in the stock market. Investors fear a potential government default, leading to a sell-off of stocks, bonds, and other assets. This kind of volatility can erase trillions of dollars in wealth from retirement accounts, 401(k)s, and investment portfolios, directly affecting individual and institutional investors. 5. Loss of global trust in the U.S. dollar. The U.S. dollar is the world's primary reserve currency, meaning that other countries and investors rely on it for stability. If the U.S. government fails to meet its financial obligations, it could damage global confidence in the dollar, pushing international investors to seek alternative currencies like the euro, yen, or even cryptocurrencies. A weakening U.S. dollar could lead to higher import prices and increased inflation. 6. Delays in federal infrastructure and defense spending. The government plays a huge role in funding infrastructure projects, defense contracts, and research programs. If the debt ceiling is not raised, federal spending on these critical sectors may be delayed or cut altogether. This could result in halted construction projects, reduced military readiness, and setbacks in scientific and technological advancements. 7. Reduced business confidence and hiring freezes. Uncertainty in government spending and economic stability could make businesses hesitant to expand or hire new employees. Companies that rely on government contracts or funding might face delays in payments, forcing them to scale back operations. As a result, job growth could slow, and some businesses might lay off workers to reduce costs. 8. Potential economic recession. If the government cannot borrow to cover expenses, consumer spending and business investments could decline sharply. With businesses cutting back on hiring and government spending slowing down, the economy could enter a recession. A prolonged financial crisis would lead to higher unemployment rates, lower GDP growth, and long-term economic instability. 9. Impact on state and local governments. State and local governments rely on federal funding for a wide range of programs, including education, healthcare, and public safety. If federal funds are delayed or cut due to the debt ceiling crisis, state and local governments may have to reduce public services, increase taxes, or cut funding for essential programs. This could lead to layoffs of public sector workers and a decline in public services. 10. Long-term damage to U.S. economic leadership. The U.S. has long been viewed as a leader in global finance and economics. However, repeated political conflicts over the debt ceiling could weaken confidence in America's ability to manage its finances. If global investors start to see U.S. debt as unreliable, they may shift investments to other countries, reducing America's financial influence and making it harder to borrow at low interest rates in the future. The U.S. debt ceiling crisis is not just a political debate. It has real and immediate consequences for the economy, businesses, and everyday citizens. If the government fails to raise the debt limit by August 2025, the country could face financial turmoil, from rising interest rates and stock market crashes to job losses and economic slowdowns. While Congress has historically found ways to resolve debt ceiling standoffs, the uncertainty surrounding these events can still cause panic in financial markets and harm economic stability. Staying informed about the potential impacts of the debt ceiling can help individuals and businesses prepare for financial risks and make smart money decisions in uncertain times.